who is accompanied by Deputy Council Member ICI, Mr. Chairman SIRC of ICI, Mr. K. Chalapathy, CS Permanent President of Society of Auditors, and Secretary for Society of Auditors, Mr. G. M. Ravichandran. Please join me in welcoming the guest of honor. I now request everybody to stand for the ICA vote.
Yaesha Subsection Jagrati. Yaesha Subsection Jagrati. Kamam Sho Nirvimana Adeva Shukram Adeva Asmin Yoshava
I now request Chairman SIRC to commence the session with a recommendation.
Very respected Srimati Geetha Ravichandran, IRS, Principal Chief Commissioner of Income Tax, Tamil Nadu and Puduchery, Honorable Central Council Member, C.G. Shekhar, Treasurer of SIRC, Geetha Ravichandran, the President of Society of Auditors, C.A.P.S. Prabhakar, Secretary of Society of Auditors, C.A.G. M. Ramaswamy, my council colleague, C. Sundararajan, very respected Sri Palnivel Rajan, IRS, Commissioner of Income Tax Admin, Sri V. Stalin, Deputy Commissioner of Income Tax Headquarters, Sri V. Ramesh, Income Tax Officer Headquarters, person, colleagues, friends, very good evening to all of you. It is a very heartening to organize a meeting with the Society of Auditors yet again, and this time to felicitate the Principal Chief Commissioner of Income Tax, Tamil Nadu and Puduchery, Srimati Geetha Ravichandran, on her assumption of coveted positions in the Income Tax Department at Chennai. I am also very happy to have been bestowed with the opportunity to offer welcome address and felicitate Madam on this great occasion. The relationship between the Institute of Chartered Accountants of India and the Income Tax Department has been one of the mutual understanding and the progressive coordination in many aspects. It is therefore in the fitness of things that we in the SIRC and the Society of Auditors organize a meeting to felicitate Madam on taking up the highest position in the department at Chennai. Srimati Geetha Ravichandran IRS has begun her 34 years of most distinguished service in different parts of this great country, holding key assignments in the Income Tax Department. On behalf of SIRC and the Society of Auditors, I express our congratulations on your elevation as the Principal Chief Commissioner of Income Tax. Madam, we are thankful to you for accepting our request to be in our midst to receive our felicitation and to address the members of SIRC and the Society of Auditors. We are pleased to extend a warm and happy welcome to you to this great meeting. I am also feeling happier to extend our warm welcome to all the functionaries of both institutions and other participants of this great evening. And I also welcome the higher officers from the department, Sri Palnivel Rajan sir and Sri B. Stalin and other officers from the department for this great felicitation program. SIRC had on many occasions conducted programs in association with the department when the government brought in new legislations which had an impact on our provision services and chartered accountants. We had the gracious presence of many senior officials of your department participating in our conferences and seminars as a guests and resource persons. ICA is having good association with the Ministry of Finance and had offered its views and suggestions to the ministry in response to their request and on own in the field of financial sector. Our members were also part of many committees formed by the Ministry of Finance and contributed their service and wisdom to the great country. Madam, I am very happy to join with the other dignitaries to felicitate you on your assuming the coveted position on behalf of Cordially and the Society of Auditors. I congratulate you and wish you a glorious tenure of office. I am sure that during your tenure, we could expect many innovative improvements in the functioning of the department and further cement in our long-standing relationship. On behalf of our members in the CIC and the Society of Auditors, I assure that the Institute will continue to nurture the relationship between both of us in the years ahead, and we will have the best opportunities to come together on many other occasions. With these few words, I once again welcome you all for this great evening Felicitation program, and thank you so much for this great opportunity.
I now request you to present a flower bouquet to the guest of honor. And may also request Treasurer SIRC of ICA, David to please get on the stage and facilitate the guest of honor with the shot. May now request Sundarajan Legal Council member to facilitate Mr.
Shivani, okay, sorry to sir. See.
May now call upon Mr. Geetha Ravichandran, Secretary of SOA, to introduce the speaker.
Good evening. So I welcome you all. Our chief guest of the day, Geetha Ravichandran, Principal Chief Commissioner of Income Tax, Tamil Nadu and Puduchery. He is an IAS officer of 1987 batch. After undergoing a training in the National Academy of Direct Taxes at Nagpur, he served in various parts of the country, including Chennai, Mumbai, Nagpur, and Bangalore. During her distinguished career of 34 years, she held the key assignments in the department, including assessment, tribal representation, TDS, investigation, central range, internal taxation, etc. She is an alumna of Geetha College, Chennai. Her interests include reading, writing, and high altitude trekking. Her poems have been published in a number of journals and anthologies. She has contributed to journals like Mountain, Park, and Direct Park with focus on spirituality. With these words, I welcome you, madam, for this function. Thank you.
I now call upon Mr. G. Shukla, Central Council member ICAI, to speak a few words.
Chief guest of the session, Madam Geetha Ravichandran, Principal Chief Commissioner of Income Tax, Tamil Nadu and Puduchery. Chairman SIRC, Janapati, President Society of Auditors, P.S. Prabhakar, Secretary, Mr. Ramasamy, Commissioner of Income Tax Headquarters, Mr. Pranirajan sir, IRS, and other departmental officials, Revati Raghunathan, Treasurer of SIRC, and Sundararajan, Regional Council Member, and all other professional chartered accountants who are viewing this program. I thought the program is in Chennai, start with the words in Tamil. Madam, 2000 years back, Thiruvalluvar has written, Thondrin Pugalodu Thondruga. The viewers are from different states, so I want to tell, when you born, you have to live with your pride. So we are having a life example before us, the Madam Geetha Ravichandran, Principal Chief Commissioner. And one more thing, the poets of the latest trend, he has written, Maberum Sabaidhanil, Nee Nadandal Unakku, Maligal Vizhavindum. Such a elite crowd when you are walking, the society should respect you like anything. Why I am telling this? Madam is from Chennai. She had her education, graduation only from Stella Maris College, just 10 minutes walk from this institution as from the graduation in botany. And as Ramasamy told, Madam has held a lot of positions after her training in National Academy of Direct Taxes. But my personal experience as a chartered accountant, her approach is motherly approach, unfriendly approach, but firmly approach. What is necessary for that seat, she will be very firm. But whenever, in my personal experience, I can share, whenever we go as an authorized representative of a client or any issue, even the recent issues on direct tax portal, new income tax portal, so many occasions, Madam called us, discussed, these are the issues, how to sort out, what are the things we can take steps. So when you go with a solution to any problem, we can get immediate solution. That is the approach. Madam, we are very happy to going to have you as the chief, now as on date, Principal Chief Commissioner. We want you to become a member of the CPDT because you are having a long tenure for another 1.5 years. So this is the approach of the Madam. So in that circumstances, as a representative of ICA Council, Madam, as the Institute of Chartered Accountants of India, we are having a separate fund for the allocating. Every year we are allocating fund for educate the public on taxation matters. Even when I was the chairman in 2014-15, we allocated every city. Because if you take the city or state of Tamil Nadu, we are having nearly 16 branches, including Puduchery. And we are permitting them to conduct tax awareness program, coordinating with the department for the public along with the Chamber of Commerce. And lot of programs we have done. We have given free hands to the branch chairman to contact the local commissioner or joint commissioner who are in charge of the jurisdiction to conduct the 3 hours or programs at the convenience of the department and what is the topic required in that area. So we can work together and take the initiatives of the government to augment revenue as well as the educate the people. As an Institute of Chartered Accountants of India, we are assuring you, we are with you on all your initiatives. Even in the new income tax portal, any support the department wants as an experienced professional and experienced institution, we are willing to extend to you the maximum. So always keep us in your heart for anything to good happen to the society in the field of income tax. And at the same time, we are also requesting our members are also sometimes come for a thing. You request your officers to be so friendly because now the connect with the officers are lost almost in the last 2 years, not only due to the pandemic on all the faceless assessment situations. And initial teething problem is also there in the faceless assessment. So I don't, being a felicitation function, I don't want to take it out area. None of the issues because we are getting good support from the department on all these issues. So as an ICI, we are having programs for the department to take all your initiatives to the public. So we are with you, ma'am. So I am congratulating Madam And one more point I would like to share very happily on this bill. Madam is blessed with two sons who are software engineer. One is in US, another is in Bangalore. How Madam is totally in charge for the collection of revenue, direct taxes in the state of Tamil Nadu and Puduchery. Ravichandran sir is the supportive factor for the Madam, not only at home, but also inside the department, who is the Chief Commissioner of TDS. So this also I can very proudly tell and share on this occasion. So both the couples sit together can generate more revenue like a Lakshmi Narayana in the department for the next financial year and assessment year. So I thank everyone for giving this great opportunity to interact with Madam. Thank you all. Thank you.
Thank you, sir. I will now call upon CAPS Prabhakaran, President of Society of Auditors, to also speak a few words.
Madam Geetha Ravichandran, Principal Chief Commissioner of Income Tax, Chennai and Puduchery, dignitaries honored on the stage. Good evening to all of you, and good evening to all those people who are virtually seeing this program from across the various places in Tamil Nadu and perhaps elsewhere. Ma'am, it's a great honor and privilege for us that you are able to come here today amidst the challenging situation of pandemic, primarily at our invitation. Both SIRC, ICA and Society of Auditors, and also you have agreed to inaugurate the study circle meetings of Society of Auditors for the calendar year 2022. Madam, as probably you are aware, Society of Auditors is a 90-year-old organization having produced doyens in the profession, and I am proud to say the Society of Auditors is even elder to the Institute of Chartered Accountants of India. We are the elder brother, but without an attitude. And Society of Auditors has gifted many presidents to the Institute of Chartered Accountants of India. Our members have become presidents of the Institute of Chartered Accountants of India. Our members have become Central Council members, including Sir G. Shekhar. And we are very happy that the Society of Auditors has been, having many programs. In fact, pandemic gave us an opportunity to reach out to a larger section of the people, because people who are Society of Auditors was generally Madras centric, Chennai centric. So people were coming only from Chennai. Now we are able to reach people out of Chennai also. So in a way, pandemic has helped us and helped the members also mutually. We are mutually, benefited. So thank you once again very much, Madam, for having come here. And about Madam Geetha Ravichandran, of course, Mr. Shekhar has mentioned a lot. I used to work under Sri N. Rangachari for 2.5 years when I was working in the United India Insurance Company. He was our financial advisor, and I was directly working under him. Mr. Rangachari, who later rose to become the CBDT chairman, also became a member of chairman IRDA. He used to tell me that an accountant cannot be kind and good. If he is kind, he cannot be good in his work. If he is good in his work, he cannot be kind. And the same thing applies to tax people also. But there are exceptions, and you have one here, Mrs. Geetha Ravichandran. She is kind and good. As Shekhar sir very rightly mentioned, she is a very nice person, very kind person, very receptive, hears your problem very patiently, and also tries to give you the maximum possible solution. So we are enormously happy, Madam, that you are here today with us, and I request you to inaugurate our study circle program. Thank you very much, Madam.
Thank you, sir. Madam, may I now request you to address our questions?
Shri Jalapati, Chairman of SIR, CEO of ICAI, Shri P.S. Prabhakar of the Society of Auditors, Shri G. Shekhar, Shri G.M. Ramaswamy. Friends, it is my honor and privilege to be present here on this occasion to inaugurate the study circle meeting for 2022. As the speakers before me have stated, we have a long association with the Society of Auditors as well as ICAI. It requires no elaboration. As has been stated by Mr. Shekhar, there is a need to create awareness amongst the taxpayers of the changes in law, of the changes in procedure, of the changes the department is undergoing in its functioning. This is being done by the department as well, and of course, the Institute has taken the lead in these matters. Taxpayer outreach and awareness is very important to us. The taxpayers are the most important stakeholder in the departmental functioning. As you are all aware, there is a taxpayers charter which is now in the statute, and our commitment from the income tax department is to adhere to all the guidelines in this charter. The timelines, there are even timelines set out. We also are committed to, we have changed. Earlier, the tax department was more in the role of a law enforcer. Now we are facilitators. We take people along and we try to resolve issues. There is a change in attitude and approach. And we have in the department ever since I joined, have seamlessly adapted to these changes. One of the most important things that has happened in the last 2 years is the faceless system of doing assessments and faceless appeals. This has been done with the intention, as the Honorable Prime Minister has said, is to ease the burden of compliance on taxpayers. There is no need for the taxpayers to visit the department and, await for someone to call them and to explain their case. Now everything is done online. The idea is to bring precision and decision making to and the department has accepted this wholeheartedly. There are certain challenges we face in this implementation because of the large scale of the effort. But as and when we encounter problems, we also come up with the solutions. I would just like to flag one issue, like it has been, I think, a concern with a lot of taxpayers and representatives. As all of you are aware, there have been several writs filed in the various courts regarding lack of opportunity to the assessee in the faceless assessment and the faceless appeal system. But what I would like to say is that while there could be certain technical glitches or even certain gaps, a large measure of point of this can be addressed to a large measure if there is adequate education of the taxpayers, if there is awareness of the taxpayers that there should be compliance to the notices issued. Whatever is the reply the taxpayer wants to give will be duly considered. Very often, this we have noticed is could be because of a wrong email, not updating the email address. So the digital footprint is not available. So there is a communication gap. In bridging this, in making sure that taxpayers receive the notices as they are meant to be received and they also respond in time, awareness can be created. So now we are looking at education of the taxpayer, education on the changes in law, the changes in procedure, but even awareness on the changes in the way we do conduct the departmental affairs is very important. So this is a matter that can be taken up to ensure that taxpayers do not lose out on something important like stating their case or explaining, making their submissions or explaining what they have to do. In the department at all levels, we are open to receiving suggestions. As you're aware, a lot of amendments from year to year are being made on account of assessing what works and what does not. So taxpayer education, while it is important, feedback is also an important mechanism. And we have, I think suggestions are called for. We have a feedback mechanism. We are open to receiving suggestions and addressing the problems any taxpayer and practitioner may face. As today's topic, I'm told, is the income-based penalties under the Income Tax Act. It is a very interesting topic. As you're aware, penalties are only levied in a very small percentage of the total cases which are assessed. The sections 270A and 270AA, which have been introduced, have also tried to deal with this issue, that is specify circumstances under which the penalties would not be levied. So this actually shows a change in the mindset or the change in the approach to give the taxpayer not just as many opportunities or as many ways in which the things can be explained or compliances can be enforced. So I am very happy that the study circle for this year is commencing with this topic. I wish all the members of the SIRC and all the participants here present virtually the very best. And I hope this fruitful discussion will explain the circumstances or the nuances of law in a way that is beneficial ultimately to the taxpayers. Thank you very much.
Thank you, ma'am, for addressing the members of our institute and also your assurance for helping the ICA and also the taxpayers at large. May I now request you to launch the SIRC app.
Just,
Thank you, ma'am, and thank you for also inaugurating the study circle meeting for the Society of Auditors for the year 2022. May I now request Chairman SIRC and President Mr. Prabhakar of the Society of Auditors to please present the memento to the Chief Guest.
Next week, give me the keywords.
We will now move on to the topic of the day. Income based penalties under the Income Tax Act by Joshita Jothi. Joshita Jothi is a chartered accountant and a lawyer who has completed her 5-year law degree in 2016 from the National University of Advanced Legal Studies, Kochi, which is a part of the National Law School established across India. She graduated law with the honors and received several gold medals for her academic excellence. While pursuing law, she has notably interned under the Honorable Dr. Justice Anika Suman and Lakshmi Koganan and Sridharan attorneys. Thereafter, she joined CA course in November 2016. In July 2021, she completed her CA and joined the firm where she did her articles and is currently practicing under the team of the reputed Sri Bhanu Shekhar Chartered Accountant. I welcome her today.
And a very young girl. And she's a lawyer as well as a doctor. Very important to this too. Thanks a lot, madam. Come back. Yeah. Thank you, madam.
Good evening, everyone. I am extremely honored and grateful for this opportunity to address you all this evening. The topic we will be discussing today is income-based penalties. We will begin with Section 270A. Section 270A deals with penalty for underreporting and misreporting of income. Subsection 1 states, the assessing officer or the commissioner of appeals or the principal commissioner or commissioner may, during the course of any proceedings under this Act, direct that any person shall be liable to pay a penalty on underreported income. So who can levy penalty? The assessing officer, for example, in cases of assessment or reassessment. The CIT appeals, for example, in cases of enhancement. And the PCIT, for example, during the course of 263 proceedings. Now, it would be important to note that the levy of penalty is not mandatory under Section 270A. Under the earlier law of penalty under Section 271(1)(c), it was explicitly mentioned in the section that the income tax authorities must be satisfied that there was concealment or furnishing of inaccurate particulars of income. However, under Section 270A, the word satisfied does not find an explicit mention. But as we go through the provisions of Section 270A, especially subsection 6 of Section 270A, we will come to understand that the levy of penalty under Section 270A is not mandatory and there is discretion with the income tax authorities. Section 270, subsection 2 tells us the situations in which there would be underreporting of income, and subsection 3 tells us how to quantify the underreported income. We will deal with subsections 2 and 3 together to the extent possible. So the first scenario is where assessed income is greater than the income determined under the intimation under section 143(1). The second scenario is where no return is filed, or return is filed for the first time under section 148 and the income assessed is greater than the maximum amount not chargeable to tax. The third situation is where income reassessed is greater than the income previously assessed or reassessed. And clause G talks about income assessed or reassessed, which has the effect of reducing loss return or converting loss into income. Now, with regard to clauses A and C, the underreported income would simply be the variation in income. That is, underreported income is equal to assessed income minus income determined under the intimation. Okay, so picking up where we left off, in for clauses A and clause C, the underreported income would simply be the variation in the assessed income or reassessed income vis-a-vis the income assessed earlier or the income under as per intimation. With regard to clauses B and G, we will see it in detail in the later slides. A point to be noted would be that only net increase in income is exigible to penalty. For example, let us take a case where there are both additions and deductions. It would only be on the net increase of income that penalty would be exigible. Also, it may be noted that for variance between the income return and or the maximum amount not chargeable to tax and the income determined under the intimation, there would be no penalty. Now we'll deal with the case where no return was filed or return is filed for the first time under section 148. If it's a company, firm, or local authority, the underreported income is equal to the income assessed. If it's other than company, firm, or local authority, the underreported income would be income assessed minus the maximum amount not chargeable to tax. In a case where assessment or reassessment has reduced the loss or converted loss into income, we will see two scenarios by way of examples. So in the first case, the loss claimed is 12 lakhs, loss assessed is 6 lakhs. The underreported income would be rupees 6 lakh. In the second scenario, loss claimed is rupees 4 lakh and the income assessed is rupees 2 lakhs. Then the underreported income would be rupees 6 lakhs. In the second scenario, let us contemplate a situation where there is enough brought forward loss to set off against this income of rupees 2 lakhs. Then can penalty still be levied? Even though the brought forward, in such a case, even though the brought forward loss would be sufficient to set off the income of rupees 2 lakhs, thereby rendering the income at rupees nil, the difference between the loss claimed of 4 lakh and nil income would still be exigible to penalty. There are three scenarios under subsection 2 dealing with deemed total income under section 115 JB or JC. So in these three cases, that is, where deemed total income assessed under section 115 JB or JC is greater than the deemed total income as per the intimation, or where no return is filed, or return is filed for the first time under section 148, and the deemed total income is greater than the maximum amount not chargeable to tax, or where the income reassessed under section 115 JB or JC is greater than the deemed income previously assessed or reassessed. In these scenarios, the Act specifically gives us a special formula to be used. Now, the rationale behind this formula is that there might be different additions in the normal, as per the normal provisions and as per the 115 JB or JC provisions. So, in order to provide for such a scenario, a particular formula has been given under the Act. So, the formula goes A minus B plus C minus D would be equal to the underreported income. Now, A minus B refers to the variation in income under the general provisions, and C minus D refers to the variation in deemed total income under section 115 JB or JC. However, in order to avoid doubly charging income tax, where there is a similar addition, where the same addition occurs under both normal provisions and under 115 JB or JC, the second proviso to section 278E provides that such amount need not be reconsidered in calculating D. So that would effectively avoid the double levy of penalty. Subsections 4 and 5 deal with penalty on source credit. So say an addition is made to income or a deduction from loss is made in the assessment of any previous year, and no penalty was levied on such addition or deduction in that year. And that addition or deduction from loss is now shown as the source of receipt, deposit, or investment in the current year, then that would be considered as underreported income as per section 278(4). How will the source for underreported income be distributed? For example, let us take a case where for 3 preceding years, addition has been made on section 68 of rupees 10,000 each. And now I am showing that rupees 30,000 as the source for the receipt in the current year. Then the 10,000 would first be knocked off in the year immediately preceding the year of receipt, deposit, or investment. The remaining 20,000 against the previous 10,000, and so on. Here, there may be a case where the source credit is relating to assessment year 16-17 or a year before that. Then a view can be taken that penalty under section 278 cannot be levied, as section 278 is applicable only from assessment year 17-18. Subsection 6 provides the exclusions from underreporting of income. So the section clearly codifies what would be the exclusions from underreporting of income. Clause A deals with a case where the assessee offers an explanation, discloses all material facts to substantiate the explanation, and the authority levying penalty is satisfied that the explanation is bona fide. The second clause deals with a case where accounts are correct and complete to the satisfaction of the authority levying penalty, but the method employed is such that income cannot be correctly determined. For example, we could say a case where the assessing officer is not doubting the genuineness of the books, but he does not agree with the gross profit which has been declared by the assessee. Could be a case which would fall under clause B. Clause C deals with a case where the assessee on his own has estimated a lower income or disallowance, and he has included such amount in his computation and disclosed all material facts in relation to the addition or disallowance. For example, let us take a case of a 14A disallowance, which is made by the assessee himself, and also disallowed in his computation. But the assessing officer is not convinced of that disallowance, and he disallows a further amount. That such a scenario could fall under subclause C. Clause D deals with a scenario where the assessee has maintained all information and documents described in section 92D, and he has declared the international transaction and disclosed all material facts relating to the transaction. Then such a TP addition would not come under underreported income. Clause E states that no penalty on the amount of undisclosed income referred to in section 271 AAB can be levied under section 270A. So from the provisions, what we can understand is that the assessee disclosing all material facts of a transaction is extremely important to be able to bring the assessee under one of these exclusions and for the assessing and to convince the assessing officer to not levy penalty in these cases, especially for the estimated additions and TP additions, and also clause A. Now clause A is a situation where any scenario could be brought under clause A if only the assessee has properly complied with all the conditions given in clause A. That is, he has offered an explanation and he discloses all material facts to substantiate the explanation. Then he would be in a position to convince the assessing officer not to levy penalty. Now, the issues to be considered in subsection 6 are the exclusions provided, that is the list of exclusions provided, is it illustrative or exhaustive? This question we will deal more in detail when we come to misreporting of income, because that is another list which is provided in the same section. Clause D. Clause D of subsection 6 mentions only international transactions. That is, it excludes from underreported income a case where an addition is made, a TP addition is made, but all necessary information has been maintained as per section 92D and all material facts have been disclosed. But it does not mention deemed international transactions or specified domestic transactions. But if we go further down the provisions, we will find that in subsection 9, that is dealing with misreporting of income, their clause F, which deals with international transactions, specifically mentions international transaction, deemed international transaction, and specified domestic transaction. So there seems to be some lacuna in the provisions, in the exclusion provisions here. What is misreporting of income? First, we must note that misreporting is a subset of underreporting. Subsection 8 itself would state that where underreported income is in consequence of any misreporting. So misreporting is a subset of underreporting, and underreporting would be considered as misreporting in the following 6 circumstances: where there is misrepresentation or suppression of facts, where there is a recording of false entry, where expenditure is not substantiated by evidence, where there is failure to record an investment in the books of accounts, where there is failure to record receipt having bearing on total income, and where there is failure to report international transaction or deemed international transaction or specified domestic transaction. Now, what are the issues to be considered in subsection 9? If we go to subsection 9, one of the circumstances that we saw is failure to record investment in the books of accounts, which comes under clause B of section subsection 9. However, if an addition is made under section 69 for failure to record investment, it will automatically, the penalty would be levied under section 271 AAC, which states that penalty will be levied in respect of incomes under section 68, 69, 69A, 69C, and 69D under section 271 AAC only. So in such a scenario, it seems that the clause relating to failure to record investments in the books of accounts is effectively inapplicable. Now, clause F deals with a case where there is failure to report any international transaction or any transaction deemed to be an international transaction or any specified domestic transaction. However, if we go to the provisions of section 271 AA, those provisions also provide the levy of penalty for failure to report any international transaction. What we can note is that 270A is a penalty that will be levied on income. So if there is a case of failure to report an international transaction, and if there is an income implication only, 270A has a role to play. However, in a case where there is a failure to report an international transaction and there is an income implication, 270A also gets triggered and 271 AA also gets triggered. Because it will be interesting to note that the provisions of section 271 AA start with the words notwithstanding the provisions of section 270A. So this would effectively lead to a double levy of penalty for the same offense. Subsection 10 deals with the calculation of tax on underreported income. So when no return of income is filed, underreported tax on underreported income plus the maximum amount not chargeable to tax, where income under the intimation or assessed or reassessed is a loss, the tax on underreported income as if it were the total income. For example, in the case we earlier discussed, where 4 lakhs would be the underreported income, that would be considered to be the total income itself, and tax on that would be calculated, and penalty on that would be levied. Now, in any other case, there is a formula that is provided, x minus y. So, which is essentially tax on underreported income plus income under intimation, assessed or reassessed, minus tax on income under intimation, assessed or reassessed. For example, let's say the underreported income is rupees 4 lakhs. Your income earlier assessed was rupees 10 lakhs. So tax on 4 plus 10 lakhs minus tax on 10 lakhs would effectively be your tax on underreported income. Now 270A subsection 11 says no penalty for an addition or disallowance if already it has been the basis for levy of penalty for the same year or any other assessment year. So for example, a case where penalty is to be levied under section 271AA or section 271AA would mean that no penalty would be leviable under section 270A. Section 270A subsection 12 states that the order passed should be in writing. Now, quantum of penalty. Quantum of penalty would be 50% of the tax on underreported income in cases of only underreporting, and 200% of the tax in cases where underreporting is a consequence of misreporting. Now, a point to be noted is that under the earlier law, under section 271(1)(c), there was a discretion in the quantum of penalty. But here, there would be no discretion. As if it's underreporting, it would be 50%. If it's misreporting, it would be 200%. The opportunity of being heard before levy of penalty is not explicitly provided in the section, but it is understood that the principles of natural justice would apply, and opportunity must be granted to the assessee during penalty proceedings. Immunity from penalty and prosecution. Section 270AA. So section 270AA states that an assessee can make an application before the assessing officer for immunity from penalty under section 270A and prosecution under section 276C and section 276CC. What are the conditions that must be fulfilled by the assessee in order to make such an application? So the tax and interest as per assessment or reassessment under subsection 3 of section 143 or section 147 should be paid within the date mentioned in the notice of demand, and no appeal should be preferred. So you have to pay the tax and interest as per the demand of notice, and no appeal should have been preferred. In such a case, you can apply for immunity from penalty and prosecution. Application is to be made within 1 month from the end of the month in which the order is received. The assessing officer shall grant immunity if the conditions are fulfilled, unless the penalty is initiated under section 270A(9). The order accepting or rejecting the application is to be passed by the assessing officer within 1 month from the end of the month in which the application was received. The order passed by the assessing officer shall be final, that is, no appeal lies from this order. And no appeal under section 246A or revision under section 264 is admissible as against the order in respect of which the immunity is granted. So you apply for immunity, you have received the immunity. Thereafter, you cannot file an appeal against that order. Now, one important thing to be considered here are the words given in subsection 3 of section 270AA. Now, I'll just reproduce that subsection for us to read. It states, the assessing officer shall, subject to the fulfillment of the conditions specified and the expiry of the period of filing the appeal, grant immunity from imposition of penalty under Section 270A and initiation of proceedings under 276C or 276CC, where the proceedings for penalty under Section 270A have not been initiated under Subsection 9. So a question arises whether the provision is to be understood as meaning that there is no immunity in cases of misreporting, or that there would be no automatic granting of immunity for misreporting even if conditions are fulfilled. That is, the AO has a discretion in such a case. Because if we go through the provisions of subsection 3, it makes it clear that in a case of underreporting where I have fulfilled the conditions, the assessing officer has to grant me the immunity. That is, his role is limited to only checking whether I have fulfilled the conditions and whether the period for filing appeal has expired. But if the latter part of the subsection says where the proceedings have not been initiated under 270A9. So in a case where proceedings have been initiated under 270A9, the granting of immunity would not be automatic, but the assessing officer can go through the application and decide. Another point that would sort of buttress why the second view could be taken is that in a case where penalty is initiated under subsection 9, that is misreporting, but actually it is a case of underreporting, then the assessee would be able to raise a plea before the assessing officer that this is actually a case of underreporting only if we go with the interpretation that immunity can be granted even in cases of misreporting, only that the immunity would be discretionary. Granting of immunity would be discretionary. A point to be noted would be that under the sections mentioned in subsection 1, there is no place for section 144. So assessment orders passed under section 144, there would be there is no scope to file an application for immunity. Also, what happens if the assessing officer does not pass the order within the time allowed under the subsection? Is it deemed to be accepted? Such a situation has not been explicitly provided for in the section, but a view could be taken that the immunity is automatically granted, especially in cases of underreporting, where the only role of the assessing officer was to check if the conditions were fulfilled. So a view could be taken that there would be an automatic granting of penalty, but we are yet to see. We have to see how the law takes its course. The third situation would be a case where the order has been passed under section 143(3), read with section 144(c). The assessee files an application for immunity. The immunity is granted. Thereafter, subsection 6 bars an appeal being filed only under section 246A. It does not bar an appeal being filed before the tribunal. So can a view be taken that in a case where the assessee has gone through the route of DRP, the assessee can get immunity and also file an appeal before the tribunal thereafter? If penalty is initiated for both underreporting and misreporting on two different editions, and if the assessee chooses to file an application for immunity, the assessee loses his right to appeal against the entire order. Because say in a case where you are denied your application for immunity for misreporting, even if your application is denied, you have lost your right to appeal against the order itself, because once your application for immunity is accepted under reporting, your right to file appeal has been effectively barred under subsection 6. Also, the time between the date of receipt of order of assessment or reassessment and the date of filing the application has not been excluded in the extension of time to file appeal against the order. Section 249 has actually excluded the time between the date of application and the date of rejection of the application for immunity. But it has not provided for an extension between the date of receipt of order and the date of filing an application. For example, let us say that you have received your order on 15th January 2020. Your date to file appeal ends on 14th February 2020. But your date within which you have to file the application for immunity ends only on 28th of February. So you may file an appeal even on 20th of February 2020. But that effectively means that your time to file appeal is over. And if your application for immunity is rejected, you will actually have to file a condemnation. Because even despite your exclusion, you will still be under duty. Section 270AA also would not apply to cases of enhancement by the CIT appeals or the PCIT or CIT. This is because subsection 1 only mentions the sections 143(3) or section 147. Now 143(3) can bring within its ambit 143(3) read with section 153A, 143(3) read with section 263, and 143(3) read with section 144C. But in cases of enhancement, there would be no scope to apply for immunity. Now, before I get into penalty in respect of certain income under section 271AA, we were talking about whether the list of exclusions provided under subsection 6 of 270A and whether the list provided as misreporting under subsection 9 are exhaustive or illustrative. So let me just read the provisions of subsection 6. So subsection 6 starts with the words, the underreported income for the purposes of this section shall not include the following, namely. While subsection 9 says, the cases of misreporting of income referred to in subsection 8 shall be the following, namely. So shall be the following, namely, and shall not be the following, namely. There is a difference between the two. We can hold the view that shall be the following, namely, is exhaustive. That is, cases of misreporting is exhaustive and it must fall only under these 6 circumstances. But when we're talking about the exclusions, we can take a view that it is not exhaustive but in fact illustrative because it only excludes from underreported income certain things. So it only says shall not be included. So other circumstances can also be brought under exclusion from underreported income. So a view can be taken this way. Also, even if a view is taken that subsection 6 is exhaustive as well, it must be noted that as long as the assessee has fulfilled the conditions of clause A and disclosed all material facts and offers an explanation to the assessing officer, it can effectively bring any case under clause A. So even if subsection 6 is held to be exhaustive, and as long as we fulfill the conditions mentioned in clause A, the assessee can still bring himself under the exclusions provided under subsection 6. Now moving on to penalty in respect of certain income, section 271AA(c), where income determined includes any income referred to in section 68, 69, 69A, 69B, 69C or 69D, then penalty is leviable at the rate of 10% of tax payable under section 115 BBE. 115 BBE provides for tax at 60%. Also, section 271AA(c) states that no penalty under the provisions of section 270A shall be imposed upon the assessee in respect of the income referred to in subsection 1. So this is where we spoke about the issue of say an addition under section 69, which would effectively come under 271AA(c) and effectively render the respective clause in 270A as inapplicable. There is a proviso in section 271AA(c) which states that no penalty to the extent the above referred income is included in the return of income furnished under section 139 and tax in accordance with section 115 BBE is paid on or before the end of the relevant previous year. So if you have included the specified income in section 271AA(c) in your return of income and you have paid the tax in accordance with section 115 BBE, no penalty under section 271AA(c) can lie in such a case. 271AA(b), where penalty by search has been initiated. Now, section 271AA(b) has undergone many changes, and we are now left with section 271AA(b)(1)(a). Section 271 AAB 1A states that where a search has been initiated and the assessee has admitted undisclosed income in his statement recorded under section 132(4), and the assessee specifies and substantiates the manner in which such undisclosed income was derived, he pays tax and interest on such undisclosed income before the due dates under section 139(1) or the notice under section 153A as the case may be, and files the return of income for specified previous year, declaring such undisclosed income therein. If he cumulatively fulfills all the 4 conditions mentioned here, then the penalty would only be 30% of the undisclosed income of the specified previous year. However, if the assessee does not fall under does not fulfill these conditions, then he would be covered under 60% of undisclosed income of the previous year. So to recap, the 4 conditions that he must fulfill are: he should have admitted the undisclosed income in his statement under section 132(4). He should have specified the manner and substantiated the manner in which the income was derived, paid the tax and interest before the due date, and also filed the return of income. Now, 2 important terms that we see here for which we need some clarity is specified previous year and undisclosed income. We would generally assume specified previous year as the previous year in which search was conducted. But it could be the previous year in which search was conducted, or the previous year which was ended before the date of search, but due date under section 139(1) has not expired, and the assessee has not filed return of income. So in such a case, such a previous year would be the specified year. Undisclosed income. Any income which is represented either wholly or partly by any money, bullion, jewelry, or other valuable article or thing, or any entry which is found in search which has not been recorded on or before the search or otherwise not disclosed before the date of search. And it could be any income represented wholly or partly by any expense entry which is found to be false and which would not have been so found had the search not been conducted. So it could either be represented by money, bullion, jewelry, or other valuable article or thing or entry found in search, or any expense entry which is found to be false. Now, what are the issues in section 271 AAB? So the section states that no penalty under section 270A would apply where section 271 AAB applies. Section 271 AAB applies on undisclosed income. But there may be a case where in an assessment, additions are made with respect to undisclosed income, and additions are made apart from the undisclosed income as well. So where additions are made apart from the undisclosed income, section 270A would apply. And for the undisclosed income, section 271 AAB would apply. Now, in a case where the assessee was not specifically asked to substantiate the manner in which the undisclosed income was derived, can he be denied the lower rate of penalty? So there are several cases which state that in such a case, provided he has fulfilled all the other conditions mentioned in order for the levy of penalty to be 30%, then simply because he has not substantiated the manner in which the undisclosed income was derived, in a case where such a question was not posed to him, then only that would not deny him from the penalty being under 30%. So certain general points with regard to penalty. The penalty proceedings are independent of assessment proceedings. That is, for example, in a case where an addition has been made and in the assessment proceedings, the addition has been upheld. Does that mean that penalty should be automatically levied on such an addition? Not at all. Because even in the case of under the penalty proceedings, if the assessee is able to substantiate before the assessing officer why the addition should not stand, or if he is able to provide an explanation, then penalty need not be levied in respect of that addition. So that is why we say penalty proceedings are independent of assessment proceedings. And where penalty has been initiated under a particular section, and the final order for levy of penalty cannot be under another section. For example, in a case where we were discussing there are both additions relating to undisclosed income and other additions. and the assessing officer simply only issues one notice under 271AA, then no penalty would stand under section 270A finally on the other additions. I hope this presentation was useful. Thank you for this wonderful opportunity. Thank you. I thank the organizers for this opportunity.
Thank you, Joshita, for the enlightening session. I'm sure the members present here and the members watching this seminar online have been benefited immensely from all this knowledge sharing. May I now call upon Mr. Raju Gopal, committee member of Society of Auditors, to present the movement to the speaker, please. I request GM Ramaswamy, Secretary of Society of Auditors, to give the vote of thanks.
Good evening, friends. So, good evening, friends. Thank you for joining the session online. Also, the members present here in person. Thank you. And also, I'd like to thank CHK Jalabri, Chairman of ICRC, for organizing the events at a very short notice. Also, thank Mr. G. Shekhar, Central Council member of the Institute of Channels of India, for being here and facilitating the chief guest of the day. I also thank Mr. P. S. Ravichandran, President of the Society of Auditors, for facilitating the chief guest. I thank Ravichandran, Mr. Raghunathan, and Treasurer of the SCRC of ICA for being here. And I thank the chief guest of the day, Srimati Geetha Ravichandran IRS, for consenting to be here to inaugurate the study session meeting of the Society of Auditors for 2022 and also to launch the mobile app of the SCRC. Though the app has been launched, it is only for the Android platform as of now. It will be upgraded to Apple in the due course, but at present is working in Android platform. I thank Madam for her time and being here with us in person and inaugurating the study session meeting of the Society of Auditors and also the app of the Institute of SCRC. In fact, SCRC, so income tax and Society of Auditors are very long relationship. As informed by the President, the Society of Auditors founded in the year 1932 and it is our 90th year. And till late 90s, we were functioning in the office of the Income Tax Office. We had a separate chamber in the main building of the Income Tax Department, and we used to interact very frequently with all the commissioners and other offices of the Income Tax Department. Post of purchasing our own building in Alas, we moved to our own premises. Till then, we are functioning in the Income Tax building. I thank all the officers of the Income Tax Department who accompanied the chief guest today. And next is I thank Joshita Jothi, advocate and the chartered accountant, for accepting our invite to be the first speaker of the year 2022. In fact, she chose the topic as the income tax penalties under the Income Tax Act. In fact, it has been suggested by her, and we had heard her talking in some other platform, and she has taken this interesting topic in such a lucid manner. I thank you for the excellent presentation, and we look forward for more such sessions in our society premises. Okay. I thank the office bearers and the employees of the Institute of Channels of India for the time and effort in organizing this program in a virtual mode, because due to the pandemic, though we want to have this session in a physical mode, that's why we set to Premier. But considering the increase in the number of cases, we had to move it to digital platform, and I thank the top members of SCRC to make it happen. Thank you very much. I thank Premlata for accepting our request to be MC today at a very short notice. In fact, due to some reason, Subsection couldn't come over here, and immediately she accepted. Thank you, Premlata. You connected in a very nice manner. Thank you very much. I thank you one and all. With this, we'll end the session. Thank you.